Have you noticed the headlines lately? Maybe you've scrolled past an article discussing global economic shifts. Sometimes these discussions mention the United States dollar specifically. They might talk about its strength or sometimes its potential weakening. These aren't just abstract financial reports for economists to ponder. They are, in fact, conversations that could directly influence your everyday experiences, from the price of your morning coffee to the plans you make for your future. Understanding these shifts is becoming increasingly important for everyone, not just for those who work in finance or international trade. So why should you, specifically, care about something that sounds as technical as dollar devaluation? It's a fair question. You have bills to pay, work to do, and a life to live. Understanding complex economic concepts might not seem like a top priority. However, the reality is that the value of the dollar is a fundamental pillar supporting your financial well-being. It dictates the affordability of goods and services, influences your savings, and can even affect your job prospects down the line. Think of it as the financial weather. You might not be a meteorologist, but knowing if it's going to rain helps you decide whether to carry an umbrella. This is about equipping you with that foresight for your financial life. When you think about money, what comes to mind? Perhaps it's the crisp bills in your wallet, the metallic jingle of coins in your pocket, or even just the digital numbers displayed on your banking app. These are certainly the forms money takes in our daily lives. But beneath these familiar appearances, money is something much more profound. It's a fascinating social construct, an agreement we all participate in, a system built primarily on trust. We trust that the piece of paper a cashier hands back to us, or the digits transferred into our account, will be accepted by others for goods and services. This collective belief is what gives money its power. Money performs several crucial jobs in our economy, functions that often go unnoticed because they work so seamlessly most of the time. Firstly, it's a medium of exchange. Instead of bartering your chickens for a new pair of shoes, you use money, which simplifies transactions immensely. So let's get right to it. What exactly is dollar devaluation? In the simplest terms, it means that the US dollar loses some of its value. This isn't just a number on a screen. It means that each dollar you possess buys a little bit less than it did before. Imagine you have a favorite recipe that calls for a cup of flour. If your measuring cup, your dollar, suddenly shrinks, you can't fit as much flour, goods and services into it anymore. That's devaluation in a nutshell. A decrease in the actual purchasing power of your money, both when you're shopping for everyday items and when you're thinking about its worth in the wider world. It's common to hear devaluation mentioned in the same breath as inflation, and while they are close cousins, they aren't identical twins. Inflation refers to a general increase in the prices of goods and services across the economy, which naturally means your money buys less. Devaluation, on the other hand, specifically refers to the decrease in the dollar's value, often considered in relation to other currencies or a fixed standard, like gold historically. Devaluation can certainly contribute to inflation, especially for things we import, because if the dollar is weaker, it takes more dollars to buy those imported goods. But they are distinct concepts. Devaluation focuses on the currency's reduced strength. To truly understand why a currency like the dollar might devalue, it helps to take a quick peek into the past. For a significant period in history, the value of many national currencies, including the US dollar, wasn't as free-floating as it is today. Many countries operated under what was known as the gold standard. This meant that the government guaranteed that its currency was convertible into a specific, fixed amount of gold. For instance, the US dollar for many years was pegged at a rate where 1 ounce of gold was worth about $35. This system aimed to provide stability and confidence in the currency's value. However, the global financial landscape underwent a monumental shift in the 20th century. The constraints of the gold standard became increasingly challenging for governments wanting more flexibility to manage their economies, especially during wars or recessions. A landmark moment occurred in 1971 when then U.S. President Richard Nixon announced that the United States would no longer convert U.S. dollars into gold at that fixed official rate. This decision, often dubbed the Nixon shock, effectively ended the international gold standard system and ushered in the era of fiat currencies for most of the world, including the dollar. One of the very first places you'll likely feel the pinch of dollar devaluation is at the checkout counter. This isn't some abstract economic theory, it's a real tangible change in how much you pay for everyday items. When the dollar weakens, goods that are imported from other countries become more expensive. Think about it, the company importing those goods has to pay its foreign suppliers in their local currency. If the dollar is worth less, the importer needs more dollars to make that payment. Naturally, this extra cost is often passed directly on to you, the consumer, in the form of higher prices for those imported products. Consider the items you regularly add to your shopping cart. That delicious coffee from Brazil or Colombia, its price might edge upwards. The bananas from Ecuador or the avocados from Mexico, they could cost a few cents more. Even things like European cheeses, wines, or olive oils will likely see price increases. It's not just luxury items either. Many everyday household goods, from clothing manufactured in Southeast Asia to electronics assembled in China, are subject to these forces. A weaker dollar means the cost to bring these items into the country rises, and that rise is reflected on the price tag you see in the store. If you've been dreaming of an overseas vacation, dollar devaluation can throw a significant wrench in your plans. The reason is straightforward. Your US dollars will simply buy less foreign currency. Imagine you're planning a trip to Italy. You'll need to exchange your dollars for euros to pay for hotels, food, and attractions. If the dollar has devalued against the euro, that means $1 gets you fewer euros than it did before. Consequently, every aspect of your trip, from that charming hotel room to that delicious gelato, will cost you more in dollar terms, even if the prices in euros haven't changed at all. Let's look at a practical example. Suppose last year, $1 was equivalent to 0.9 euros. A hotel room priced at 180 euros per night would have cost you $200. Now imagine the dollar has devalued, and $1 is only worth 0.8 euros. That same 180 euro hotel room will now cost you $225. That's an extra $25 per night, just because of the shift in currency value. Multiply that by a week-long stay, and add in increased costs for meals, train tickets, and museum entries, and your carefully planned travel budget can quickly become insufficient, forcing you to spend more or cut back on your experiences. This impact isn't limited to grand European tours or exotic Asian adventures. The unseen thief: how devaluation erodes your savings. Dollar devaluation quietly diminishes your savings purchasing power. It takes more dollars to buy the same goods and services. Your emergency fund buys less over time. This erosion affects short-term savings goals. Understanding purchasing power is crucial for financial planning. Holding cash during devaluation reduces financial capacity. Ripples in the pond, less obvious daily changes. Dollar devaluation sends ripples through the economy, affecting daily life in less direct yet significant ways. Local businesses face higher costs for imported supplies. This can lead to higher prices for consumers. International money transfers are also impacted. Fuel costs can rise, affecting transportation and goods prices. Economic uncertainty can reduce consumer confidence and spending. The shifting sands of employment jobs in a devalued dollar era. Dollar devaluation reshapes the job market, favoring exports and domestic tourism while challenging import-reliant industries. Wage increases may not keep pace with rising living costs, affecting real income. Understanding these shifts is crucial for navigating your career path. Section 2. Your nest egg under pressure. Investments in a new light. Dollar devaluation changes how you should think about investments and savings. Holding cash in a devaluing currency is like holding water in a leaky bucket. The goal shifts to preserving and growing the real value of your assets. Seek investments that outpace dollar devaluation. Move beyond traditional savings accounts. Different asset classes perform variably under dollar pressure. U.S. companies with overseas revenue might perform well. Foreign earnings convert to more dollars, boosting profits. Companies relying on imports may see rising costs. International stocks offer diversification and exposure to stronger currencies. Bonds can be risky, as fixed payments lose purchasing power. investors turn to real assets during currency devaluation. Real estate often rises with inflation, hedging against devaluation. Real estate is a classic example. Commodities like gold and silver are stores of value. Their prices may increase as investors seek safe havens. Other commodities like oil and agricultural products can be considered. Financial literacy and strategic planning are crucial. Regularly review your portfolio and understand asset risks. Make adjustments as needed. Seek advice from a qualified financial advisor. Develop a diversified strategy to protect your nest egg. Section 3. Reevaluating retirement. Securing your golden years. Dollar devaluation can upend retirement plans, diminishing the purchasing power of savings. Fixed pensions and cash savings are particularly vulnerable. Healthcare and essential expenses could become harder to cover. Reevaluating retirement strategies is crucial. Consider investments that protect against inflation and devaluation. Proactive planning and diversification are key. Section 1. Echoes from the Economic Archives: Why History Holds Vital Clues. Currency devaluations are not new. They have occurred countless times throughout history. Studying these events provides invaluable insights. We learn how economies react and how policies succeed or fail. History acts as a guide, offering warnings and paths to resilience. One of the most infamous examples of currency devaluation happened in Germany during the Weimar Republic in the early 1920s. Following World War I, Germany faced immense reparation payments. The government printed vast quantities of money, leading to hyperinflation. Prices doubled in days, then hours, wiping out life savings. The German mark's collapse serves as a stark warning about the dangers of unchecked government spending. While the Weimar Republic offers a dramatic case study, currency devaluations are not confined to history. Many countries have faced significant currency devaluation and high inflation in recent decades. This includes nations like Argentina and Brazil. Even strong economies like the UK have faced devaluation. The British pound, for example, faced crises in 1967 and 1992. These episodes remind us that currency stability requires constant vigilance and sound economic management. The impact on citizens often mirrors extreme historical examples. The struggles are real, even if less catastrophic. Devaluation makes imported goods expensive and travel a luxury. Savings lose value, pushing people to find ways to preserve wealth. Often they convert money into stable foreign currencies. This creates financial insecurity for many households. Common threads in devaluations include loss of purchasing power and economic uncertainty. Government policies and central bank actions are critical. Sustainable economic policies and fiscal responsibility are essential. Financial literacy and understanding currency risk are vital. Diversifying assets and staying informed help navigate currency instability. The thought of your hard-earned dollars losing value can certainly be unsettling. It is a concern that touches everyone, regardless of their financial standing. However, you are not merely a passive observer in this economic theater. You possess a significant degree of agency when it comes to your personal financial strategy. Taking proactive, well-informed steps can make a substantial difference. This section is all about empowering you with practical approaches. The goal is not to predict every economic tremor. Instead, it's about constructing a robust financial arc to navigate economic weather with confidence. Diversifying your assets is crucial in a shifting economic landscape. Don't put all your eggs in one basket. Spread investments across various assets like real estate, gold, and stocks. This cushions your portfolio from declines in any single asset class. Consider real assets like property and commodities, and explore international stocks. Also, inflation-protected securities can preserve purchasing power. Lastly, invest in yourself to boost earning power. Section 3. Cultivating financial resilience, income, mindset, and lifelong learning. Protecting yourself financially isn't just about where you put your money, it's also about how you generate it. Diversify your income streams. Relying on a single paycheck makes you vulnerable. Rising costs can compromise your financial stability. Develop multiple income sources. Freelance with a skill you possess, turn a hobby into a side business, invest in passive income assets, or explore gig economy opportunities. Each stream adds to your financial safety net. Cultivate a long-term perspective and emotional resilience. Economic uncertainty can provoke anxiety. These emotions can lead to poor decisions. Avoid rash moves like panic selling investments or chasing speculative assets based on hype. Resist these impulses. Focus on a well-thought-out financial plan. Economic cycles include expansion and contraction. Maintain a steady hand and avoid short-term emotional reactions. The economic world is in a constant state of flux. What works today might not be optimal tomorrow. Commit to continuous financial education and adaptability. Keep learning about personal finance and investment strategies. There are countless resources available. The more you understand, the more confident you will become. Be adaptable. Review and adjust your financial plans as circumstances change. Rigidity can be a significant handicap. While global economics are beyond your control, you are not helpless. Take proactive and empowering steps. Build your financial knowledge, budget wisely, manage debt, diversify assets and income, and maintain a resilient mindset. Navigate economic challenges with confidence. Shape your financial future amidst uncertainty. Understanding the dollar's evolving value. The US dollar is more than just paper notes and coins. It supports our financial structure and daily lives. The dollar's value is dynamic, influenced by global forces. This affects everything from coffee prices to long-term plans. Understanding this helps us navigate economic shifts. Dollar devaluation means your money buys less. It impacts travel, imports, and daily expenses. Planning helps mitigate these effects on your finances. Embracing the winds of change. Finding silver linings and strength. Economic shifts can be daunting, but they also present opportunities. History shows that change uncovers new avenues for those ready to adapt and innovate. A weaker dollar can boost American-made goods competitiveness globally, stimulating domestic growth and job creation. This shift encourages local production, innovation, and community strength, fostering a resilient economy. Financial literacy grows as people adapt, leading to better financial decisions and long-term security. Embrace change, stay informed, and navigate your financial future with confidence and resilience. Section 3. Charting your course. Proactive steps for a secure financial future. Empower yourself by understanding global economics and managing your financial destiny. You have significant influence over your financial future. Use practical tools and knowledge to transform anxiety into action. Make informed choices and take proactive steps. Stay informed, budget wisely, and manage debt. Diversify assets and income streams for stability. Commit to lifelong financial education. Start today with small, manageable steps. Consistent actions build a resilient financial foundation. Face the future with confidence and preparation. The power to secure your financial well-being is in your hands.